So it seems like an agreement has been made on in principle for the debt ceiling crisis. We're going to talk about exactly what that means, the details behind the actual deal itself, and then the future implications of what it has in the economy and also what it means for the markets and the future pricing of everything else. So in this episode, we're going to be talking about the debt ceiling crisis that was quote unquote avoided. We're going to be going over the debt ceiling details, the unlimited spending potential from the actual deal, why it's in principle, and the possible rate hikes that are coming in June. But before we go any further, I do urge you guys to go check out our newsletter where we post stuff like this even before we make these videos so you can get up-to-date things on topics like this. It'll be the first link in the description down below. So over the weekend, a deal was finally struck between Biden and McCarthy on the whole debt ceiling deal. So we're going to go into some of the details. What they continuously say is that not one party received everything that they wanted, but there are some key factors in this entire deal that you do really need to understand. The first massive thing that you guys need to understand is that there is a cap on discretionary spending. So the important thing to read here is that the deal would suspend the $31.4 trillion debt ceiling until January 1st of 2025, allowing the government to pay its bills. Basically, what this is saying is that there's not going to be a cap on the debt ceiling. So imagine that they just pushed it away, and for right now until January 1st, 2025, there's an unlimited amount of spending potential in order to pay off all of our debts, to accrue as much debt as we need in order to keep the recession from coming, and a lot of other implications. But that's not a good thing, because the more money that we continuously take into debt, it's just going to cause for future problems. And also, the more money that we create, the more inflation problems that we have, which we'll get into that in a little bit. Now, there's also a couple other key things that I want you guys to know throughout this deal, but another one is the student loan spending. The reason that this is so important is because it's going to pause the student loan repayments in late August, and it's going to start in, I believe, beginning or late July, which means that people are going to have to start paying their student loans much sooner. And this is why that's a bad thing. People have become so accustomed to not paying for their student loans because it's been on pause for many, many years now. I think we're getting close to like the 3-year mark at this point. If I'm wrong, correct me in the comments. But when we look at the other debt levels in the United States, we can see that we're at record highs for literally everything. So just about everyone has got credit card debts, massive auto loans, the housing market. All of these debts are at record highs. And to put the cherry on top for all that, a lot of these are at very high interest rates as well. Now, when we get to the actual student loan part, you can see that student loan payments are set to resume this summer, which again are a little bit earlier than that August timeframe. Student loan debt just hit $1.6 trillion. So now on top of all these debts that people are paying, and in no time in history have people had more debt than they do today, now you're going to be adding on student loan payments to the already struggling Americans who are trying to pay off their debts for everything else. And so this could cause potential, defaults on any one of these debts, whether it be credit cards, auto loans, the student loans. And a lot of that money is money that the government should be getting. And if they don't get that money, well, that's also the predicament that we're in right now. Because if we continue to look here in a little bit, we're going to see that the government is spending more money than they're actually bringing in. Now, to kind of go back to the debt ceiling details, we can go right here, and these are kind of the 7 biggest points that we want to take away. But again, the debt ceiling has been raised indefinitely for the next 2 years. They're going to cut spending by about $50 billion, even though they're taking on around $4 trillion. And one thing that I kind of forgot to mention in the beginning is that all of this is still in principle. Now, what does that mean? So Biden and McCarthy have agreed on a plan, but they still have yet to push it to Congress. So the deal actually has to get through Congress. They need to approve it, and then it'll actually take effect. Now, one important thing is that the debt ceiling timeline, the X date is around June 5th, which is next Monday. If this goes to Congress and it goes through a filibuster where they can't agree on the details, it's going to be pushed back, which makes it extremely close to that debt ceiling deadline, which means that they might have to change these around again. So what you're seeing in these details aren't on paper yet and haven't been agreed on. So this is subject to change depending on how close we get to that deadline and if they just don't agree on a deal. But one thing that I do want to take away is that when you look at the deal, in the essence of it, their spending cuts, or what they're getting rid of, is just 2.2% of our GDP. And now to put that into perspective, basically we're adding $4 trillion of debt over the next 2 years, and we're only cutting spending by $50 billion. And again, until January 1st, 2025, almost the next 2 years, there's really no cap on how much debt we're going to bring in. And to put that into perspective, imagine if you were a person and you were taking on $40,000 of new debt in just 2 years, but you only cut your budget by $500. And that's adding debt that you already have, assuming that you're a person with $320,000 of debt. So it's a little bit different when you put it into the context of a person, because that's a little bit more relatable. But basically, it's the same. What the government is dealing with is what the people are dealing with. We have massive amounts of debt, and instead of bringing more money in, we're just continuously accruing this debt onto our balance sheet. And eventually, we're just kicking the can down the road until eventually you just can't continue to add debt to yourself. Now, if we go to usdebtclock.org, this is a website that actually tracks the national debt, how much money we're bringing in, the total debt to GDP ratio, stuff like that. Now, if you look at the U.S. national debt, right now we're at that $31.8 trillion. A couple of figures that I really want to point out is that these are the largest budget items down here. You can see that Medicare, Social Security, Defense and War, and the interest on our debt. Those are our 4 biggest things. Now, the big thing is that when we talk about budget cut spending, it's very difficult to take money away from Medicare and Social Security, especially with an aging population. Once the baby boomers start to leave the workforce and they need these things, it's going to be hard to take money away from that. So the next plausible thing is that you take it away from discretionary spending, things like defense and war, infrastructure, education. And then obviously you can't take money away from the interest payments, and you could see that is going up by the second. And another thing I want to point out is that when you look at the U.S. federal tax revenue, we're at $4.6 trillion. So that's the money that we're bringing in from taxes. But if you take a look over here, the U.S. federal spending is at $6.1 trillion. So when you think about it as a perspective as a person, imagine you're making $100,000 a year and you're spending $110,000 a year. So you're slowly getting yourself into more debt. You have 2 options. You can either bring in more income or you can cut your spending. Something that the government has problems with is that they're trying to figure out ways of how to bring in more money. But again, taxing people to death is only going to make people either 1, want to find more loopholes, or 2, just leave the United States as a whole. And so another problem that they have is they have to figure out ways to cut their spending, because when you look at the total debt to GDP ratio, it's at 134%. So we have way more debt than we actually have in total GDP. Now, a massive problem that this causes is that over the next 2 years, we're going to be having a lot of money being printed, a lot of money being spent, and a lot of new debt being added to our balance sheet. And what does that do? Exactly what happened during the pandemic. When we had a lot of money being printed, inflation happens. And this is exactly where we're at right now. We had an inflation problem. Now, when you take a look in the past, every time we've had high inflation, it's also correlated with somewhat of a recession. And since then, we've had high inflation, but no recession yet. And a lot of people are saying, oh, now that we have the debt ceiling crisis figured out, we're not going to go through it, or we're going to have a soft landing, or whatever it may be. But if we take a closer look, if we zoom in right here, you could see that, sure, since June of 2022, inflation has been going down. And for the first time since June of 2022, core PCE inflation has actually gone up from 4.19% to 4.36%. Now, that's a bad thing, because that's going to force the Fed to look at this and be like, okay, inflation is actually not coming down as fast as we want. And so what do we do now? We either have to raise interest rates or we have to figure something else out. And when you look at what the Fed might be doing, June 14th is the next time they meet and determine, are they going to raise interest rates or are they not? Right now, we're sitting at a 63% probability that they're going to raise the interest rates by 25 basis points, which basically means that we're going to have harder times in the market. We're probably going to have more banking stress. And again, in July, it'll also depend on what inflation does, because if they continuously raise interest rates and inflation doesn't get fixed, well, they're going to have to continue to push the pressure if their real goal is 2%. And it's crazy how fast this stuff can change, because just a week ago on May 23rd down here, you could see that raising interest rates only had a 28% probability, but now we're sitting at a 63%. And when you talk about raising interest rates, the biggest thing that comes to many people's minds is the banking stress that has been caused by that. When you take a look at 2008, obviously that was a massive bank failure, right? It was the Great Recession over real estate, but a lot of banks were caught up in that with mortgage-backed securities, and that's where a lot of them lost their liquidity. That's where they went insolvent, and that's where they went out of business. When you take a look at the comparison, the big thing was that in 2008, there were a lot of small bank failures, right? We had that massive one, Washington Mutual, which was bigger than any of these. But when you look at the first three big bank failures, these three already are almost just as much in total volume as all of 2008. So that really begs the question, if we do raise interest rates, which banks are going to fail next? Because if we've already almost in volume done the same as 2008, what's the next bank, or what are the next several banks, or what are we going to see from here? Now, obviously, something like that should be scary for the markets. And when we're looking at it since March, I mean, the S&P has risen almost 10% at this point. And just over the last week from down here, we've risen almost 2%. And so when you look at the S&P 500, you're asking yourself, you're like, wow, this has been a very resilient market. And if you take a look back, it looks like it's kind of just been oscillating between these two zones, between 4,200 and then kind of at these lows at 3,800. But when you take a deeper look, it's not the S&P or the entire market that's doing well. It's stocks like Meta, who rose almost 200% just about a month ago. And then obviously stocks like Nvidia, that since October over the last 9 months has pumped over 200%. And literally in just the last week, it's pumped around 40%. So obviously the AI craze is very, in my opinion, very similar to the dot-com bubble, where over maybe even the next few weeks, any technology company that has anything AI involvement, they're going to pump. And we've seen it with Nvidia. And many people say that this is very overvalued, which I do believe. Like, the valuation of Nvidia at almost $400, literally pumping 200% in the last 9 months. Sure, this is an amazing place to sell off because it's destroyed this all-time high right over here. But again, the markets are completely irrational. We have the debt ceiling crisis that was happening. We have massive inflation problems that we're trying to deal with. And many economists think that we are going to go through a hard landing. But yet the markets are still pumping. They're still providing massive gains. I mean, if you were to just put your money into Nvidia or Meta at some point, or even just the S&P 500 since March, you would be making money in these markets. But yet if you take a broader picture of what's going on, technically, we should be seeing some hard times, but it doesn't seem like that in the markets. And again, the markets can be very irrational. And again, for me, looking at Bitcoin, because Bitcoin was basically designed for this, right? It was born out of the 2008 recession, out of these bank failures. And so when we take a look back, how does Bitcoin fare against these bank failures, and what could it do in the future? Obviously, the SVB failure in March 10th, we had this massive skyrocket, right? This was a signal for a lot of people that, hey, maybe this is a safe haven. Obviously, Bitcoin fared well when the SVB failed, but when you take a look at First Republic, it didn't do so well, right? It had kind of a little bit of a pump. A lot of people probably thought we were going to have the same thing as SVB happen, but it did fall. Now, Bitcoin kind of sits at this $28,000 range. I personally think at this point, When we take a look left, we've seen a lot of liquidity over here when we had that big crash back in May of 2022. We're kind of sitting at these levels. Again, a psychological level of 30,000. I think what we could see is maybe a minor pump, maybe back up to 30,000 at most for Bitcoin. But I think eventually what we're actually going to see is one more dip to the downside. How far we go, it really depends. I mean, we do have a couple levels that we could reach. I think a probable level is maybe around 22,000, possibly even taking out these lows and coming all the way down to 15,000 is a huge possibility. But I think anywhere in the range of 22,000 and 15,000 could be the next drop that we see for Bitcoin. And I know that's a massive range, but again, depending on how bad things get, that's kind of where, we gauge it. So that's just my personal opinions on Bitcoin and what we could be seeing. But I think in the long term, again, we're in that pre-halving year and really nothing happens. A lot of interest drops off on cryptocurrencies and Bitcoin. A lot of the volume drops off. And until the actual halving happens, that's when we really start to see a pump. So this is the time to accumulate Bitcoin, because this is when a lot of interest is fading away. And this is where a lot of the accumulation phase happens. So that's everything I have for this video. I hope you guys found it valuable. But until the next video, I'll see you guys then. Peace.